Today's breaking news out of Baghdad has caught the attention of every household, every trader, and every business across Iraq. The central bank has just announced a significant cut to the supply of dinars in circulation. On the surface, this might sound like a technical financial decision, but in reality, it carries deep consequences for daily life, for the broader economy, and for Iraq's long-term monetary future. So what does it really mean when the central bank reduces dinar supply? Let's break it down. At its core, reducing the supply of money is a strategy to control inflation. When too many dinars are chasing too few goods, prices rise. You've probably noticed how quickly food, fuel, and imported items can jump in cost when the exchange rate shifts. By cutting the money supply, the central bank is trying to reduce pressure on prices, stabilize the exchange rate, and restore confidence in the dinar. But while that might sound good in theory, the reality on the ground is more complex. For ordinary citizens, less money circulating means tighter liquidity. Banks may restrict loans, businesses may find it harder to access credit, and salaries may feel smaller compared to rising costs. Families already stretched thin could feel the squeeze even more. For traders and importers, the move sends another message. Cutting dinar supply often means demand for the US dollar will rise, because people want a stronger, more stable store of value. Already, street markets today are reporting higher dollar prices, with some exchange shops running out of cash as buyers rush to secure what they can. This fuels speculation, whispers of a possible revaluation, or at least a major monetary adjustment in the near future. Why did the central bank act now? The answer lies in the pressures it has faced over the past months. Inflation has crept up as the dinar weakens against the dollar in street markets. Oil revenues remain high, but they are still heavily dollar-based, leaving the economy exposed. By cutting the dinar supply, the bank is trying to defend its reserves and buy time, keeping control while preparing the ground for longer-term reforms. But here's where it gets interesting. Cutting the money supply isn't just about inflation, it's also about signaling. The central bank is sending a message to both domestic and international players that it is serious about controlling the market, that it will not allow the dinar to spiral out of control, and that it is ready to use all available tools to stabilize the currency. The problem is, this policy comes with risks. For businesses already struggling with delays in government payments, for families depending on stable prices, and for regions like Baghdad and Erbil where exchange rates already differ, this move could deepen economic divides. The wealthy, who already hold much of their assets in dollars, may not feel the pain. But middle-class and working-class Iraqis, who rely on dinar-based salaries, could feel it immediately in their wallets. So what does this mean in practical terms? If the policy succeeds, we could see inflation ease, the gap between official and street exchange rates narrow, and more confidence in the dinar in the months ahead. If it fails, however, we could see even more pressure on the local economy, higher prices, slower growth, and possibly social unrest as people struggle with rising living costs. And then there's the elephant in the room. Could this be a step toward a larger change, like a currency revaluation? Many in the dinar community have speculated for years about a potential RV or redenomination. While today's move doesn't confirm such a plan, it does fit the pattern of policies that often precede major monetary shifts. By tightening supply, the bank may be preparing the financial system for something bigger, whether that comes in weeks, months, or longer down the road. For now, though, Iraq is at a crossroads. The central bank has made its move. The markets are reacting. Citizens are watching closely. And the world is asking, will this bold step bring the stability Iraq desperately needs? Or will it spark more volatility in an already fragile system? The answer will depend on what happens next, how the bank follows through, how the government manages oil revenues, and how ordinary Iraqis adapt to the new reality. What's certain is this: every decision about the dinar affects not just the economy, but the lives of millions of people who rely on it every single day. So, as the central bank cuts dinar supply, Iraq stands at a turning point. Will this be remembered as the moment the country regained control of its currency, or as the spark of even greater challenges to come? Only time will tell. Now that the central bank has cut the dinar supply, the immediate question on everyone's mind is simple. How will this affect daily life? The short-term effects will be felt first in liquidity. With fewer dinars circulating, borrowing money from banks will become more difficult. Small businesses may struggle to access credit, which could slow investment and hiring. Families that rely on loans for big expenses, like housing, education, or healthcare, may find those options drying up. At the same time, prices for basic goods may fluctuate sharply. If traders believe the dinar will weaken further, they will increase prices to protect themselves. That means imported food, electronics, and fuel could rise in cost. But if the central bank's plan works, demand for dollars may ease slightly, and inflation could cool down in the coming weeks. That's the gamble. The bank is betting that cutting supply now will reduce pressure later. For government employees and those paid in dinars, this move could create uncertainty. A teacher's salary, a soldier's paycheck, or a clerk's monthly wage may stretch less far at the market if the dollar keeps rising. Meanwhile, those who hold savings in dollars, or who trade directly in foreign currency, may feel more protected. This divide between dollar holders and dinar earners is one of the biggest challenges Iraq faces today. But let's look at the bigger picture. In the long run, cutting dinar supply can prepare the ground for deeper reforms. By controlling inflation and limiting excess liquidity, the central bank could be setting the stage for a stronger currency policy, possibly even a revaluation or redenomination in the future. The question is whether Iraq has the political and economic stability to make such a bold move. If oil revenues remain strong, if banking reforms continue, and if corruption is kept in check, then a revaluation becomes more realistic. But if dollar demand continues to outpace supply, Iraq may find itself fighting the same battle again and again. The risk is that without structural changes, like diversifying the economy beyond oil and strengthening local industries, the dinar will remain vulnerable no matter how much the supply is adjusted. Another layer to consider is public trust. When people believe the dinar is stable, they are willing to save, invest, and spend with confidence. When that trust breaks, the economy slows because everyone rushes into dollars or gold. The central bank knows this, which is why its decision today is about more than numbers, it's about psychology. By cutting supply, it's trying to send a message. The dinar is worth protecting, and the state is in control. Of course, there are risks. A tighter money supply can hurt businesses, reduce job growth, and create frustration among the public. If the effects are not managed carefully, the very move meant to strengthen the economy could weaken it in the short term. That is why many will be watching the coming weeks closely, especially how the exchange rate behaves on the streets of Baghdad, Basra, and Erbil. So, does this mean a revaluation is coming? The truth is, no one can say for certain. What we can say is that today's move is part of a pattern. First stricter rules on dollar transfers, then adjustments to banking systems, now a cut in dinar supply. Each of these steps points toward a larger strategy, one that could eventually change the way Iraq's currency works in global markets. For now, though, Iraqis should prepare for volatility. Expect fluctuations in exchange rates, expect shifts in market prices, and expect more debate about where the dinar is heading. The central bank has played its card, and the market will respond. Whether that response is confidence or chaos depends on what happens next. One thing is clear. The future of Iraq's economy will be written not only in oil prices and government policies, but in the daily lives of its people, how much they can buy, how much they can save, and how much faith they have in their own currency. The central bank's decision to cut dinar supply is not just about stabilizing money. It's about stabilizing the very foundation of Iraq's financial future. The story isn't over yet. This is only the beginning.